In markets, capital doesn't care about intentions, it cares about outcomes. It's a cold, hard truth that governs the flow of trillions of dollars across the global economy every single day. Over the last few years, a handful of America's most recognizable brands made strategic decisions that had very little to do with traditional business fundamentals, things like pricing, logistics, or product quality. Instead, they were decisions centered on narrative alignment. The result wasn't a temporary PR headache. It was tens of billions of dollars in lost shareholder value, erased from balance sheets with brutal efficiency. You already know the names because their stories became front-page news. Bud Light, Target. These weren't just companies, they were institutions of American commerce, seemingly invincible pillars of their respective industries. Yet, they stumbled, and the market's reaction was swift and unforgiving. But while these giants were absorbing historic financial damage, other companies were watching. They were observing, analyzing, and taking detailed notes. And that brings us to Hilton. The global hospitality leader has been navigating the same complex cultural landscape, facing its own pressures and political tripwires. This isn't a political video. We are not here to debate the merits of one ideology over another. This is a case study in incentives, consumer behavior, and capital discipline. Today, we're going to break down the mechanics of why some brands triggered permanent demand destruction, while others managed to avoid a similar fate. We will examine what this tells us about how markets, stripped of all the noise and headlines, actually enforce accountability. To understand the scale of what happened to Bud Light, you first have to appreciate what it was. For over 2 decades, Bud Light wasn't just another beer brand. It was the undisputed category leader. It held the title of the highest volume beer in America, a position that gave it immense structural advantages. Unparalleled pricing power, near total distribution dominance, and a level of brand inertia that most companies can only dream of. That inertia, the tendency of consumers to keep buying what they've always bought, was a cornerstone of its value. Until, suddenly, it wasn't. In April 2023, a single marketing decision acted as a catalyst. A brief partnership with transgender influencer Dylan Mulvaney, intended to celebrate a personal milestone, triggered a consumer backlash of a magnitude rarely seen in modern business. This backlash quickly evolved into something that markets understand with perfect clarity: a sustained, organized, and deeply felt boycott. Here's the key analytical point, and it's crucial to understanding the financial carnage that followed. This wasn't about short-term outrage. It wasn't a fleeting social media storm that would blow over in a news cycle or two. This was a fundamental identity mismatch between the brand and its core customer base. For generations, Bud Light had cultivated an identity centered on everyday, working-class Americans. The marketing, the messaging, the cultural associations, all of it was built around this demographic. The Mulvaney partnership was perceived by this exact audience not as an inclusive gesture, but as a direct repudiation of their values by a brand they considered their own. The result was that Bud Light's core consumers didn't just stop buying the beer temporarily, many of them substituted it permanently. Competitors like Modelo and Michelob Ultra didn't necessarily win because they launched a brilliant new marketing campaign or radically improved their product. They won because a massive wave of demand shifted away from the market leader, and they were positioned to catch it. This is a classic example of demand substitution, and once it happens, it's incredibly difficult to reverse. The numbers tell the story of this structural break. They are not just statistics. They are data points measuring the destruction of a brand's most valuable asset, customer loyalty. Within weeks of the controversy, Bud Light's US sales plummeted by nearly 30%. This wasn't a slow leak. It was a catastrophic failure of the dam. The losses didn't stop there. The sales decline deepened, with some reports showing that even well into 2025, sales remained down as much as 40% from pre-boycott levels. The parent company, Anheuser-Busch InBev, saw its market value crater, erasing a staggering $27 billion at the peak of the drawdown. In total, the boycott cost the company over $1.4 billion in lost U.S. revenue in 2023 alone. By June 2023, Bud Light had officially lost its crown as the #1 selling beer in America to Modelo, a title it had held for more than 2 decades. It didn't just fall to second place, it soon slid to third in retail sales and even lost its top spot in draft sales, a high-margin business, to its own sister brand, Michelob Ultra. The market's verdict was clear and brutal. It labeled this event correctly. This was structural damage, not a cyclical PR problem. Once consumer demand breaks this decisively, and substitute products become locked into new purchasing habits, simple tools like price cuts and rebranding campaigns are often ineffective. You cannot simply apologize your way out of a broken business model. That's not a political statement. That's a fundamental lesson in microeconomics. As the Bud Light firestorm was demonstrating the high cost of brand alienation, another American retail giant found itself in a remarkably similar situation. The context was different, but the financial and behavioral outcomes were nearly identical. Target's competitive advantage was always built on a clear and powerful value proposition. It was the go-to retailer for suburban families. Its brand was synonymous with convenience, a degree of neutrality, and a broad, inoffensive appeal that made it a trusted destination for millions. It wasn't a niche retailer. Its success was predicated on being a place for almost everyone. In May of 2023, that carefully constructed positioning fractured. The company launched its annual Pride Month collection, but this year's offering was perceived differently. The collection was more prominent, more expansive, and featured products that many of its core customers, those suburban families, found questionable. The central issue wasn't the simple existence of a Pride-themed product line, which Target had offered for a decade. For many, the backlash ignited over 2 key points: the aggressive placement of these displays at the front of stores, and the nature of specific items, such as tuck-friendly swimwear for adults. False claims on social media that these swimsuits were for children exacerbated the situation, but the proximity of the items and the general marketing approach created a firestorm. This was compounded by the discovery that one of the collection's designers also sold products featuring satanic imagery, a fact that intensified customer confrontations in stores. When consumers feel that a brand they have long trusted no longer understands or respects them, they don't always organize a formal protest. Often, they do something far more damaging. They quietly change their behavior. They walk away. Target's response to the escalating situation only amplified the damage. Facing intense backlash and volatile circumstances that threatened employee safety, the company announced it would remove certain items and relocate Pride displays in some stores. This attempt to find a middle ground was a catastrophic failure. It signaled internal confusion and a lack of conviction, which is lethal in the eyes of the market. It failed to appease the original critics while simultaneously angering activist groups who viewed the reversal as an act of cowardice. The consequence was immediately visible on the stock ticker. The market repriced Target's equity downward with ruthless speed. In just a few weeks, the company's market capitalization plunged by over $9 billion, with some estimates putting the total loss closer to $15 billion. The company reported a 5.4% drop in second quarter comparable sales, a decline that CEO Brian Cornell explicitly linked to the negative reaction to the Pride collection. The incident caused long-term erosion of trust with its most profitable and essential demographic, the very customers its entire business model was built to serve. Once again, the market enforced discipline. This wasn't driven by op-eds or angry tweets, but by the cold, hard mechanics of revenue declines and equity repricing. A brand had misjudged its identity and its relationship with its core customer, and capital fled as a result. Now we arrive at the most important part of this analysis, because it isn't a story of collapse. It's a story of observation and adaptation. Hilton, the global hotel giant, did not experience a financial catastrophe on the scale of Bud Light or Target. and that is precisely why its story matters so much. While other corporations were either stumbling into or doubling down on narrative signaling, Hilton appears to have done something increasingly rare in corporate America. It adjusted its course quietly and deliberately. It learned from the multi-billion-dollar mistakes of others without needing to make them firsthand. In its annual reports filed in early 2025, a fascinating and significant change occurred. The term ESG, an acronym for environmental, social, and governance, had completely vanished. In the previous year's report, the acronym appeared 23 times, often linked to the company's core strategy. This year, 0. It was methodically replaced with more neutral, business-focused terms like corporate responsibility, sustainability, and references to its Travel with Purpose program. This was not an oversight or an accident. It was a calculated, strategic decision. Over the past several years, the term ESG has evolved from a framework for risk management into a political lightning rod. For a large segment of consumers and investors, it has become code for prioritizing a progressive political agenda over shareholder value and core business performance. By scrubbing this loaded term from its official communications, Hilton sent a clear, unambiguous signal to the market. We are returning to the basics. We are in the business of hospitality, not political activism. This pivot wasn't a press release or a dramatic apology tour. It was a capital allocation signal, communicated through the dry, formal language of a financial filing. It was a message aimed not at activists, but at investors, analysts, and customers who prioritize performance over politics. And this move isn't happening in a vacuum. A broader trend shows other brands are taking similar notes. Reports from mid-2025 indicated a significant drop in the number of large U.S. companies publishing standalone sustainability reports, a move seen as a strategic recalibration in a politically charged environment. Look at Cracker Barrel. After facing its own fierce backlash for a rebranding effort seen as a departure from its core identity, the company not only scrapped a new logo in late 2025, but also reportedly removed its DEI and Pride pages from its corporate website. These are not the actions of companies that are deaf to their customers. They are the actions of companies that saw the tens of billions of dollars Bud Light and Target effectively set on fire and decided they wanted no part of that inferno. Hilton's message, though delivered quietly, was simple and powerful. We sell hospitality, nothing more, nothing less. And so far, markets have rewarded that restraint and focus. This brings us to the central thesis. This entire analysis isn't truly about woke versus anti-woke. That framing, while popular in headlines and on social media, misses the real, actionable lesson for anyone interested in how markets function. The real takeaway is this: public companies are not ideological entities. They are demand-driven systems designed to generate returns for shareholders. When a brand makes a series of critical errors, markets will respond with cold, mathematical precision. These errors are alienating its highest value customers. This is the cardinal sin. The 80-20 rule often applies where a minority of your customers drive a majority of your profits. If you signal to that core group that they are no longer valued, they will leave, and the economic foundation of the brand will crumble, signaling uncertainty about its own identity. As we saw with Target, attempting to please everyone after a backlash begins is a fatal strategy. It projects confusion and a lack of leadership, which spooks investors and further alienates all sides of the customer base. Prioritizing narrative over revenue. When a company's communications and strategic decisions appear to be driven more by alignment with a specific social or political narrative than by the clear goal of selling products and generating cash flow, the market takes notice. The market's response to these errors is not emotional. It is mechanical and predictable. Multiple compression. The company's stock will be seen as riskier, and investors will be unwilling to pay as much for every dollar of its earnings. Its price-to-earnings multiple will shrink. Demand substitution. As we saw with Bud Light, customers will find alternatives. Once those new habits are formed, winning back that demand is exponentially more difficult and expensive than keeping it in the first place. Permanent brand repricing. The brand itself loses value. Its identity, once a source of strength, becomes a liability. The market permanently writes down the value of that intangible asset. That's not politics. That's a masterclass in incentives enforcing discipline. Hilton didn't win by choosing a different political side. It won by choosing neutrality, clarity, and a relentless focus on its core business, cash flow. So, what is the final verdict in this comparison? Bud Light and Target offer a stark and expensive warning. When companies forget who actually pays the bills, markets do not negotiate. They punish. The tens of billions of dollars in shareholder value they destroyed serves as a powerful testament to the ultimate authority of the consumer wallet and the unforgiving nature of capital. They chose a side in a culture war, and the result was a financial gut punch from which they are still trying to recover. Hilton, on the other hand, represents a different model, the path of quiet observation and strategic adjustment. By watching the public implosions of its peers and deliberately steering its corporate identity back toward the neutral, profitable ground of business, Hilton is demonstrating that maybe, just maybe, some corporations are finally getting the message. The primary duty of a publicly traded company is to its shareholders. That legal and fiduciary responsibility is best met by serving the widest possible customer base, not by alienating half of it to appease a vocal minority. In today's highly polarized world, the consumer holds more power than ever before, and the market is the ultimate arbiter of corporate strategy. Bud Light and Target learned this lesson the hard way. Hilton seems to be learning it the smart way. The job is, and always has been, simple. Serve customers, protect shareholders, and, for the most part, stay boring. Because in markets, boring is profitable. If you want more breakdowns like this, where we strip away the political headlines and focus on the underlying incentives, capital flows, and real market consequences, make sure you're subscribed and ring the bell for notifications. In the next video, we'll apply this same analytical framework to a much larger entity, central banks and their conduct of monetary policy. Because it turns out, governments and institutions make the same fundamental mistakes that companies do, and markets punish them in exactly the same way.